Welcome back to the Monthly Income Podcast. I'm Tom Lydon, and each month we're joined by the founders of Neos, Garrett Palella and Troy Cates, who help us focus on the importance of maintaining healthy monthly income. Great seeing you guys. How are you doing?
Good. Great to see you.
Doing great, Tom.
Good. So first of all, this podcast has been really popular and it's booming. So we want to thank everybody who's come to us every month, thousands of viewers across the world. It's great to see the initial reaction, and we're thrilled to be building this channel kind of as a way to communicate with investors of all types. So thanks for being here. Also, guys, there's been a lot going on in the market. We've seen a lot of volatility. There's been some investor uncertainty. So we want to talk about that a little bit too. Maybe we can start. Garrett, what are you seeing in the market? It's been a little bit shaky. What type of reaction have you got from clients, from investors, from conversations you've had with advisors?
Yeah, so I think everything's coming down to tariffs, right? And tariff uncertainty. As we've started to unfold this year and the new administration, really the push from them on equalization of tariffs that the U.S. might be paying, coming out of the country, wanting to normalize those. But I think the big question is how much of those tariffs going to be, right? We've gotten a little bit of clarity at the moment. There's still some uncertainty coming down. And I think ultimately it comes into trying to understand how to price that in. And that being actually the biggest unknown. So we're starting to see a lot more volatility in the marketplace. What I think we'd love to talk about always, and what the conversations with advisors and investors have been, is volatility doesn't have to be a concern, a big negative in the portfolio. There are ways to leverage volatility as an opportunity to generate income, to protect your portfolio against it. And so find ways that if we know we're going to continue to see an increase of volatility through at least this administration, whether it's just the next month or we get some more clarity on tariffs, or maybe it's going to be the next 6-12 months, but we got several years coming. And I think those are the conversations we're having today, is what's going on, what are our thoughts in the marketplace, but what can we do to ultimately turn this negative or concern of a perception from investors and clients into a positive.
Troy, on the back of what Garrett's saying, a lot of people will look at the flows in ETFs, and during times of volatility, you tend to see, when the market pulls back, people selling equity allocations. That hasn't been the case with Neos. It seems like markets with volatility continue to bring in new assets. Why is that? Why would you say?
I think the advisors we talk to, the different buyers that we talk to, I think as they're looking, as the market sells off a little, when that happens, when you see the equity market selling off, we get a pickup in volatility. And when that pickup in volatility comes in, it helps our portfolios. We're able to bring in more income from the option portion of the portfolio. So a lot of people that allocate to these type of products are really looking for a pullback, an increase in volatility. Maybe they get a little more income off of it, but also looking for good places to enter these ETFs.
Can you dig a little deeper there? I've learned a little bit that that's the case, but how come during times of volatility, the distributions seem to increase?
Sure. So if you think about where we're sourcing most of this income from, take our high income equity products. We're sourcing the income from the option market. So we're using those index options, whether it's on the S&P 500, the NASDAQ 100, or maybe the Russell 2000, and we're sourcing the income from the options market. So when the volatility increases, we're bringing in and able to get more premium off of selling calls, for example. And when we could do that, we have more to distribute out to the shareholder. So that increase in volatility is not such a bad thing for funds like ours that are option-based ETFs.
No, it's great. And I've seen especially one ETF, BTCI, the Bitcoin ETF, when you launched it, the dividend was around 27, 28%. Currently in the 33% area. It's crazy. Garrett, back to you. Which products should investors look at if they're really looking for that high monthly income, especially with the pullback that we've had? Give a couple examples maybe.
Sure. So I think in talking with advisors, if you're looking to take an equity bet and get something with the highest degree of current income, right, you're going to take a little bit more risk. You're going to want to leverage the higher amounts of volatility. And so with us in particular, that would sit more with our equity high income suite like QQQI SPYI, IWMI, right? And even some new ones across real estate, or the Bitcoin one that you had mentioned, which was BTCI, or that real estate was IYRI, right? Those are the ones that are going to give you more equity market exposure. And so you're going to generate a higher degree of income, really kind of targeting that 12, ish range. So call it from 10 to 15 on equity products, or even up to 30 in Bitcoin. And so it really depends on what the investor's appetite is and what is their risk profile. Is it driven for the high monthly income and the willingness to take a little bit more of this volatility and an opportunity to get long equities? Or do you want to be in something more on the fixed income side because, you just like to have a lot lower vol, lower risk, but get that nice incremental, tax efficient income on top of what your core fixed income or high yield or even short duration is going to give you?
Troy, talk a little bit about QQQH. Garrett mentioned QQQI. How is that different, and how might the volatility be? I'm going to use the buffered word, but it's not really a buffered strategy.
Yeah, so QQQH is our hedged equity income product that utilizes the NASDAQ 100. So similar to QQQI in the sense that you're long all NASDAQ 100 names in the portfolio and you are selling calls. But the difference is we're also, with QQQH, buying a long put spread to give you a measure of downside protection. So in these more volatile times, like we've seen in the past month or so, we really look to give you a measure of downside protection as the market sells off while still providing that monthly income. And again, it goes back to what Garrett was saying. It's really, what is your risk appetite? You want to be involved in the NASDAQ 100. You want to be able to capture some of that growth and upside and get income at the same time. Do you want to take more of a equity-like bet and take QQQI for the higher income? Or do you want to take a QQQH and look for a measure of downside protection and have a lower vol product with maybe a little bit less of a distribution on a monthly basis?
Hey, Garrett, back to you. The Fed's still signaling maybe 1 or 2 rate cuts this year. Talk about maybe a couple products that you folks offer that would be favorable in those environments.
Yeah, so I think structurally, just talking to investors today, we're seeing kind of 2 things over the last, I'd say, month or so. One is, how do I continue to harness the short duration opportunity in my portfolio, but with the Fed signaling rate cuts, how do I get some incremental income on top of that? We actually do have a pretty unique product called CSHI, where we're long 1 to 3 month treasury bills, but we're doing a laddered option overlay using put spreads to ultimately generate, 100 to 150 basis points of additional tax efficient income a year. And so when you think about that, we were north of 5%, right, in Fed funds rates about a year ago, and those money markets were kicking off a lot more than they are today. We still at CSHI are still in that north of 5% range because we're looking to incrementally add kind of 100 basis points or so above that. So between CSHI staying in the short duration, but opportunistically being able to enhance the income from it, we've definitely seen adoption from advisors continuously trying to find that extra yield enhancement. But we've also seen some long duration trades as well. So there's some other products we have across the fixed income that get you that long duration. But I think it's really a conversation of, if the Fed is going to cut at least 1, if not 2 more kind of 25 basis point slugs here, then we've really started to talk to a lot of advisors about getting that incremental income on the short side of things, but also seeing them start to extend duration to more medium, longer term, especially in the treasury side, because you're able to take that kind of credit risk out of it and the interest rate risk. And now you're really just talking about, long duration.
Makes all the sense in the world. Troy, there's still $7 trillion in money market funds. What about for people who want to keep their powder dry a bit? What should they look at?
I think going back to what Garrett was saying, CSHI is our 1 to 3 month T-bill product that's giving you an extra 1 to 1.5% over time with that option portfolio, that put spread strategy on top of it. So if you're thinking about, where I want to put my cash for a little while, but earn a little bit more income than you might in some of the other ultra short duration products or maybe a money market, CSHI could be a good product to look at.
You guys talk about tax efficient income, and that's really important. There are a lot of products out there in this space. We're seeing this grow tremendously with many different issuers. Distributions look great, but the tax efficiency, the income isn't always there. Garrett, talk a little bit about that, and what are some of the key components that people need to be aware of?
Yeah, I think this is a real big topic of conversation with investors that we speak to, because for us, we're very passionate about what is your net after tax return, right? And I think a lot of other asset managers or issuers don't focus on that. They think about just maybe what gross yield could be generated off each individual product or asset class. For us here at Neos, we're really always thinking about the tax efficiency. And for any investor, they should be thinking about that is, we're around tax time at the moment, and what ultimately are you going to end up keeping after you got to pay your taxes coming out of taxable based accounts? And so for us, we think about a lot of different ways. It's, of course, using an ETF that offers tax advantages with that wrapper as a whole, putting investment strategies in it. It's the instruments that we ultimately use and invest in, is how can they be the most tax efficient choice or selection that we have for investors, where you could get that same view in maybe 2 or 3 different investment vehicles, but we're ultimately going to utilize the most tax efficient way. And then embedding tax thoughts and investment philosophy within our strategies. And so ways that you can tax loss harvest, right, is another way. And so when you couple kind of a multi-tiered approach, thinking about not only the investment process and the returns, but really how to generate those on a tax efficient basis, that's a meaningful uptick for investors on that net after tax basis. And we just think that that really should be the view for investors, is what is your net after tax return versus that gross risk that you're taking in any investment in your portfolio.
Yeah, very important. Troy, nerd out with me a little bit here. And when we talk about, flat or down markets, what are general expectations that investors should have regarding distributions, and also how that might affect the overall performance?
Sure. No, it's a question that comes up a lot. If you think about our equity high income products like SPYI or QQQI, in a flat to down market, the fund should outperform the underlying reference index. So for example, SPYI in a flat to down market should outperform the S&P 500 by the amount of income we bring in from the short call portfolio. Granted, the product is not a hedged or buffered product, as we were talking about before, but you will outperform by the amount of that income that comes in. If we continue to see a downward trending market, again, like we've seen in the past month, we'll have volatility pick up at that time, and maybe we'll be able to bring in a little bit more income from that short call portfolio.
Okay, and talk about during rising markets, how are the options and the income generated affected?
Sure. When the market's moving higher, obviously you have your underlying equities moving higher with the market. But again, as we roll these products, we're rolling and selling calls on a monthly basis. We're selling out of the money. And the nice part about our rules-based strategies is we're not covering 100% of the notional. So there's times and periods where maybe there's 75% of the portfolio covered, for example. So there's a good 25% of the portfolio that can continue to appreciate as the market moves higher. We're still bringing in enough income to hit those target goals of, say, SPYI, that 10 to 12% range. So we're still bringing in enough income to do that, but we're also able to appreciate with the market. Of course, if the market continues to really rally higher within that 1 month period, it can get capped out at some point. And that's really the big risk when you're thinking about covered call products in general, is you're not going to capture all of the upside of the underlying reference asset during a big bull market.
Right. Understand. And look, I know that for these portfolios, the way you manage them, there's a specific discipline. You're not checking the wind or things like that. However, based on how the market reacts at that period of time, you're working hard to offset gains and also harvest losses. So touch on that, and what's the importance of doing that?
That's a really important part, and it kind of goes back to the conversation you're having with Garrett around the tax efficiency, that getting that net after-tax distribution as high as possible. When you mention harvesting losses, we're not selling one stock to buy another out of the portfolio. We're looking at harvesting losses within the option portfolio. So as I was mentioning, if we're selling and rolling these calls on a monthly basis, we're bringing in cash to use as a distribution and send that out. But if there's a loss associated with that specific trade, that loss can stay in the portfolio and be carried forward indefinitely until it's paired off with another gain. So as the end of the year comes and everybody starts to look for their 1099s because they need to pay their taxes, what happens is our fund accountants and our auditors will go through all of the actual P&L from the option portfolio and any equity trades throughout the year, and they will associate and tie together what part, whether it's long-term capital gains, short-term, or return of capital, which I know we've talked about a lot. We're not looking to return principal, but from an IRS standpoint, if we can get part of the distribution categorized as return of capital, you're lowering your cost basis and deferring your taxes down the road.
Garrett, again, I'm right up to my eyeballs right now and trying to get everything over to my accountant so we can make it by April 15th and not have to go on an extension. It's been really nice to be able to share the results and see what percentage was return of capital for SPY and QQQI. Did you get any feedback from advisors and investors when they started to really understand the tax efficiency of 2024?
Yeah, so I think the advisors and the investors that take the time to really think about how the tax efficiency can really play into an investor's overall asset allocation, I think is when things really click. So you can have a great product, and if you can think about the core benefits, right? If we're talking about the equity high income, suite of being in that, 10 to 15% yield with exposure and diversification in major benchmarks. But when you start to understand the tax efficiency and the ability, as you had mentioned, Tom, like looking at last year, having over 90% defined as a return of capital. And so that kind of 12-ish%, having the majority of that taken home, right, really resonates. And then the further structuring of understanding that over long periods of time, right, you're deferring that income to being all into a long-term capital gains. That really helps compound wealth. And I think that's something we love to talk about, right, on this podcast and with investors as a whole, is just talking about that from a high level is like, you want to compound your wealth and get into retirement or achieve and leverage being in retirement on the most efficient basis as possible, right? That's what's crucial in either our products, but just thinking about that holistically as an investor, how those compounding effects actually mean, right? Warren Buffett's out there big time always talking about compounding interest. Well, let's take it from compounding interest on a ordinary income tax rate of actual interest and being able to recategorize that from ordinary income into long-term capital gains, right? And that for a lot of people could be a 20, 30% difference on the net tax after effect. And that's what's like really interesting and exciting to talk to investors about, because that can be incredibly powerful compounding that on years and decades to come, especially for estate planning and, of course, passing these on to heirs and beneficiaries.
Thank you, gentlemen, and thanks for joining. If you're having fun, if you're learning, please like and follow. We look forward to seeing you next month on the Monthly Income Podcast. Take care, guys.